How come real estate agents are always telling you that it is a good time to buy? Is it true, and why do they say it? That's what I'm going to get into this video. I'm also going to talk about the very worst thing that we know of that can happen in real estate. And I'm also going to talk about the third thing, which is leverage, which is tied into all of the others. All right. So is it always a good time to buy? And the answer is, of course, it's not. But I want to take you to a little chart. I love charts, love them very much. And I'm going to take you to a chart of Kent County, Michigan. This chart is got different numbers on it than other places in the country, but the trends are the same. This chart is going to show all the way from 1995 to 2026 today. All right, you ready? Here it is. Check it out. And this is what you see. Every line is a year, January through December, every year. And so the blue line up here is us. In 2026, we're halfway through the year. And what you will notice about that blue line is, lo and behold, it is the highest line on the chart. And the reason for that is housing prices are higher today than they have ever been since 1995. And so when realtors tell you, hey, that now is a good time to buy, a lot of what that is leaning on is that the houses are more expensive than they were last year, yes, but they're also very likely cheaper than they're going to be next year. And so from that very basic rationale, it's always a good time to buy. Now, you've been living in Grand Rapids, living in Michigan, you have felt the reality of home prices rising. And the temptation is to think, there's no way they can keep going up, right? What you see here, you see this 334% number. That figure is how much housing prices have increased from 1995 to 2026. And guess what that is? 10% every year, year over year over year, more than 10%. And so we've seen a 300% increase. If you got a house for $100,000 in 1995, it would be worth $300,000 today. And so let's dig into that a little bit more closely, because people will say, yes, well, we have seen markets crash during that time. And that is true. We sure have seen them crash, haven't we? Now, if you look at this chart, it's showing you every year where housing prices went up. And you can see right smack dab in the middle where they did not. And we have 4 years in here between 2006 and 2009 where prices in fact went down, and they went down a lot. 3.6%, 2.2%, 13.6%, and then 25% down in 2009. Goodness gracious. And so that drop in the housing market is the most significant hit to the housing market that we've seen in our lifetimes. And so it's about the worst that can happen. Now, again, no one has a crystal ball, but that's a pretty good example. It was pretty serious, a pretty good example of the worst case scenario. So let's actually just talk through that. Now, if, however, the reason for this crash was that there were a lot of bad loans that were written to people who shouldn't have had these loans, right? But the people who shouldn't have had these loans got bad counsel a lot of times, and also made unwise choices to take on mortgages that were going to put them in a position where they were unable to live within their means. And this is what happened. And so back then, just like now, back then, if you made a decision to enter into a contract that you were not going to be able to afford, that was a poor choice. People could make poor choices then, they can make them now. Problem was, there was all these loan products out there that enabled people to make poor choices more easily, right? Like the payment's not going to go up immediately. It's going to go up in a couple of years, and you imagined that you'd be able to afford it by that time, and then you couldn't afford it, and then the interest rate went up with a variable loan, and people got into all sorts of trouble. So you need good counsel. And I am happy to say that while there are some practices that are not ideal, there's a lot of great lenders out there, and the laws are a lot stricter regarding this thing to protect us from exactly these types of scenarios. So you got yourself in a situation and you could no longer afford your payment, and you had to sell your house, or the house was foreclosed on. That's about the worst thing that could happen. So I want to be clear. If you kept making your payment, the worst thing that would happen was that you had an unrealized loss. That if you continued, as we saw earlier, like eventually turned into a 10% year over year gain. Now, if you had managed to briefly sell and then buy again, you could have theoretically earned even more than 10%, right? But if you had just continued, you would have seen a 10% gain over time. That's what the average is. If, however, you're in an unfortunate situation where you were foreclosed on and you lost your house, that would hit your credit. In those times, banks were taking pennies on the dollar, right? And oftentimes, for the most part, people did not have to pay back the entire amount because the banks ate a lot of that, right? And so there was hit to your credit, but with a few years, you're able to get back into the market and make a purchase again. And if you're able to do that before 2011, 2012, you were still buying at an incredibly lower rate than where you purchased, right? So a foreclosure is caused by making a contract that is going to put you in a position where you live outside of your means. That is the number one bad thing that can happen. It's poor decision making. And poor decision making can happen then, and it can happen now. And poor decision making without good counsel. That's what I would say. Now, there are terrible things that happen. People lose jobs, and there are other circumstances like that I don't want to be insensitive to. But by and large, most of this financial crisis was caused by poor decision making and poor counsel. So nobody has a crystal ball. Nobody knows what's coming next. I can tell you that Grand Rapids is a strong market. We do not have enough housing, and it's difficult to imagine a housing crash when we don't have enough houses. People need to have a place to live. Those sorts of predatory loans are not available anymore. And so things are a lot more stable. Now, one of the pressures that is there is that it is tough to get into the market, right? From a debt to income ratio standpoint, housing is expensive and wages haven't risen to that point. But those factors do not predict a crash of the market. So that being said, if something unexpected were to happen, because those things do, what I've just walked through with you is about the worst case scenario. If you're able to continue making your payments, you're going to come through on the market and you're still going to end up seeing what we have seen, which is 10% returns. In other words, your money doubling in 10 years. Now, I want to talk about the last thing I told you that I was going to talk about, which is leverage. Those of you who invest in the stock market may be more familiar with the concept of leverage. In the stock market, oftentimes it is referred to as trading on margin. But essentially the concept is that you are allowed to make an investment that represents a greater amount of cash than what you have on hand. And while I don't recommend doing that unless you're very sophisticated in the stock market, it is commonplace in the housing market. So what does that mean? What that means is when we've been talking about these home values that have been going up by 10% and 10% and 10%, it's not your initial investment that's going up by 10%. It's the value of the house that's going up by 10%. And so back in the day, if you bought a house for $100,000, and you put 10% down, that was $10,000. But when that went up by 10%, in the first year, that's $110,000. And the next year it was $120,000. Whereas 10% on your investment is only $1,000. So in 10 years on an investment of your cash of $10,000, you might make in the stock market, if you were doing 10%, you would make another $10,000. So you would have $20,000. But in the real estate market, if you use the $10,000 to buy a $100,000 house and that house appreciated by 10%, you have $200,000 instead of $20,000, right? And so the concept of leverage is powerful. And so when it comes to investing in real estate, I think the worst thing that can possibly actually happen is not the anomaly that happened a few years ago that when it comes to right down to it, isn't that bad since you need a place to live. And if you can either push through it or you can rent out the house, if you can navigate through that time frame of a crash and still own real estate, then the net negative is not that bad compared to the risk of staying out of the real estate market. If you're entirely out of the real estate market, you are missing out not just on 10% gains, right? But actually, if you want to take the example I gave you of 10% down on $100,000, right? A $10,000 investment in the first year, you actually made 100% of your money back, right? Because 10% on 100,000 is 110,000. So the risk is missing out on doubling your money, right? And what we're talking about here, if you want to use the 10% down situation, right, is doubling your money every year, which is crazy. And so of your actual money that is down. So missing out on that growth for yourself and for your kids and for their kids, real estate creates generational wealth. And I think the worst thing that can happen is to miss out on that opportunity. And so after all of that, we are back here where I said we were going to go, which is what realtors always say: it is still always a good time to invest in real estate. Now, what does make a difference, there is a good way to invest and there is a bad way to invest. And the reality of the situation is that you can invest poorly today, regardless of what the market is going to do tomorrow, or you can invest wisely today. There are good deals and bad deals that exist today, right? And so, and whether or not you get a good deal or a bad deal is much more measurable and significant than whether or not the market is going to move down next year, right? Buying well today is far more important than the crystal ball of the market tomorrow, because we know that over time the market will recover. So with that, I am going to leave you with this. If you have not invested in real estate, I would highly encourage you to think about it some more, ask some questions. Feel free to message me if you have any questions. It is a significant thing that will actually change the trajectory of your life and the life of your family. So if you haven't invested in real estate yet, think about it. I'm going to release more videos like this. And if you like them, let me know. I'd appreciate it. All right. Peace out.